Hi everyone, this is Chris Devins and you are watching Senior Hour as usual. Last month I was talking about ways for seniors to save money. This is Saving Money for Seniors Part 2. As you know, the purpose of Senior Hour is simply I give out financial advice and other things around issues specifically relating to seniors. I'm very glad to see you today. Thank you for watching again. Today we're going to continue on the same subject we were on last month, which is just general ways for senior citizens to save money, okay? So my phone number, of course, will appear every once in a while on the there I am right there on the screen. Well, what you can do is I can always suggest that you consult a financial advisor or about some of the things that I say, or maybe an attorney. But you can always feel free to give me a call there at that phone number if you have any questions about any of the things that I'm talking about. Okay. With that said, being a homeowner, your home is one of the major ways that you can save money, because a home is one of our major expenses. Being a homeowner in today's world means that you need to economize anywhere you can. So you might be surprised to find out what the top 10 monthly expenses for the average American family and senior are. They are: the mortgage is number 1, credit cards are number 2, transportation is number 3, utilities is number 4, groceries is our 5th top expense, clothing is the 6th top expense in the top 10 monthly expenses. Health care, recreation and entertainment is number 8. Child care is number 9, and personal items are number 10. Of course, how you would rank those depends on your lifestyle, etc. But most of those expenses, it's kind of hard to live without. So what that means is that our home, our mortgage, and just generally maintaining our home, that's our number 1 expense, especially for seniors who are on a fixed income. Now, many seniors have their mortgage completely paid for, but many seniors don't. So that mortgage is there for a lot of us. So generally, the highest expenses that you will incur by being a homeowner are the mortgage loan, your property insurance, your property taxes, your home maintenance. If you are one of an estimated 66 million people who own their home, you probably have a long-term loan of 20 or 30 years, and you make a mortgage payment once per month. Hopefully, your loan is a fixed-rate mortgage, because that's usually the most economical choice. Why? Because your monthly payment stays the same for the life of the loan. This way you are shielded from interest rate hikes. Adjustable interest rate loans commonly cost less at the starting line, but they can cost you big bucks on down the road when the interest rates go up. When you use a flexible rate loan, it's similar to riding a roller coaster with its repetitive peaks and valleys. Short-term loans let you build up equity in your home faster, but the customary 30-year mortgage loan usually gives you the lowest payment per month. This is especially important for families and seniors who are, on a fixed income. The extra cash that you save from the lower payments can be used to pay other debts. And then when you have the extra money available, you can apply that towards the principal of your loan. So we're going to talk about 3 basic ways to slash the cost of your mortgage loan. There are 3 basic ways you can save money on your mortgage. You can get a lower interest rate, you can increase your monthly payment, or you can make regular lump sum payments. Unless you already have a bottom of the barrel interest rate on your loan, you should take some time to shop around and find the best interest rate available. If you have a $100,000 loan for 30 years, say at 8.5%, your payments would end up being around about $768 per month, not including taxes or insurance. But if you could refinance your loan, the same $100,000 for the same length of time, but at a 7% interest rate instead, your payment would be only $665 a month. That's a savings of $100 per month right there. Multiply that times 12 and you could save at least $1,200 a year. That's a chunk of change. So consider refinancing your mortgage. Home equity loan might even be the right move for you. With a home equity loan, you can deduct the interest off of your income taxes. That's an added bonus. There's a certain satisfaction in knowing that you haven't paid more interest than you needed to. You can watch your savings grow. By lowering your interest rate, you can either pocket that extra $100 or you can reinvest it and make it grow so that you can save even more money in the long run. Now, how do you do that? You simply take that $100 and apply it towards your mortgage loan every month. That means instead of making a $665 payment, you're actually paying $765 towards the loan. The result is you'll be well on your way towards paying off that 30-year mortgage 10 years early. That's a major difference. Even if your loan has a prepayment penalty clause, it may still be to your benefit to pay off the loan early. Lump sum payments, that's another way to save money on your mortgage. Lump sum payments add up. If you need to spend the extra $100 on other things, that's fine. You can still make lump sum payments one or more times a year when you have additional money to spare. Sources of added income might include a hefty income tax refund, an inheritance from a rich uncle, or a year-end bonus from your job. It would be a wise idea to talk to your current lender and then shop around and get the best interest rate, points, and fees from at least 5 other lending institutions. You want to find a mortgage loan rate that is at least 1% lower than the interest rate you are currently paying. Then look at the numbers to see how they compare. Talk to your accountant or financial planner for information on how much each loan would cost you and how each loan would affect your taxes. The whole idea in a nutshell is to pay off your mortgage loan as quickly as possible. The faster you pay, the more money you will save in interest charges. Still, another way to achieve these results is to pay 1/2 of your monthly mortgage every 2 weeks. This method of payment is an incredibly easy way to make a 13th payment on your mortgage loan every year without interrupting your budget. When you are making a loan, before you sign on the dotted line for a new loan, though, you should call several lenders for rates and terms based on the type of mortgage you want. You will need to ask the following questions so that you can be sure this loan is right for you. How long is the term of the loan? What is the minimum monthly payment? Is there a maximum? What is the annual percentage rate? Is the interest rate fixed, or is the proposed loan an adjustable rate mortgage? If so, what would the maximum interest rate be? How often might the rate change, and what determines the rate change? Are there any annual fees or transaction fees? What are the closing costs? Refinancing is definitely an option for some people. There are other ways to save money on your home expenses, which is the #1 expenses for most of us, including many seniors. Even though you must carry a certain amount of insurance coverage on your home and its contents, you can still save your insurance budget from exorbitant costs. There's one insurance expense that you can do without. One insurance you can cheerfully do without is called private mortgage insurance. This is an insurance that you must sometimes have to protect your mortgage lender in case you default on the loan. Obviously, you don't want to have to pay for this type of insurance, but if your credit rating is poor and you are considering